What's up, everyone? Welcome to Investment IQ Insights. And let's be honest, the stock market can seem like this big, scary, mysterious thing, right? But the truth is, it doesn't have to be that way. In this video, the ultimate beginner's guide to investing in the stock market, we're breaking down the stock market in a way that's easy to understand, even if you're a complete newbie to investing. We'll cover everything from the basics of what the stock market actually is, to different investment strategies, and by the end of this video, you'll feel confident and ready to start investing your money the right way. So, if you're tired of seeing your money just sit in a savings account, earning next to nothing, this video is for you. Imagine a giant farmer's market, but instead of fruits and vegetables, you're buying and selling pieces of companies. That's essentially what the stock market is. A place where buyers and sellers come together to trade stocks, which represent ownership in publicly traded companies. When you buy a stock, you're buying a tiny slice of that company, and as the company grows and becomes more profitable, the value of your stock goes up. And just like at a farmer's market, prices can go up and down based on supply and demand. The more people want to buy a particular stock, the higher the price goes up, and vice versa. Now you might be wondering, where does all this buying and selling actually happen? Well, it used to be done in physical locations like the New York Stock Exchange, but these days most trading happens electronically through online platforms called stock exchanges. These exchanges, like the NYSE and NASDAQ, act as marketplaces connecting buyers and sellers from all over the world. So whether you're a seasoned investor or just starting out, understanding the basics of the stock market is crucial for building wealth over time. Remember, knowledge is power, and in the world of investing, the more you know, the better equipped you'll be to make smart decisions with your money. Now, let's dive into a specific type of stock called common stock. When people talk about stocks, they're usually referring to common stock, which is the most prevalent type of stock out there. Owning common stock means you own a piece of a company and have the potential to earn money in two main ways: dividends and capital appreciation. Dividends are like bonuses paid out to shareholders, typically on a quarterly basis. When a company makes a profit, they can choose to reinvest those profits back into the business or distribute a portion of them to shareholders as dividends. Think of it as getting paid just for owning a piece of the company. The second way to make money with common stock is through capital appreciation. This simply means that the value of your stock goes up over time. As the company grows, innovates, and increases its earnings, demand for its stock tends to rise, driving up the price. If you decide to sell your shares at a higher price than you bought them for, you'll make a profit. However, it's important to remember that stock prices can go down as well. Factors like economic downturns, industry changes, or even a company's poor performance can negatively impact stock prices. Now, let's talk about two main approaches to stock market investing: active investing and passive investing. Active investing is like being the head coach of your own investment team. You're constantly researching individual stocks, analyzing market trends, and making trades to try and beat the market. It's time-consuming and requires a lot of knowledge and experience. Passive investing, on the other hand, is like setting your investments on autopilot. Instead of trying to pick individual winners, you invest in diversified funds that track a specific market index, like the S&P 500. This strategy is all about matching the market's return rather than trying to outperform it. So, which approach is right for you? Well, it depends on your personality, risk tolerance, and how much time and effort you're willing to put in. Active investing can be potentially more rewarding but also riskier, while passive investing is generally considered less risky and more hands-off. It's important to weigh the pros and cons of each approach and choose the one that aligns best with your financial goals. Now let's talk about the difference between long-term investing and stock trading. Think of long-term investing like planting a tree. You carefully choose a healthy sapling, nurture it, and patiently wait for it to grow into a strong, mature tree that bears fruit year after year. That's the essence of long-term investing. Buying quality stocks or funds and holding onto them for years, even decades, to benefit from compound growth. Stock trading, on the other hand, is more like playing a fast-paced video game. It involves buying and selling stocks frequently, often within short time frames, to try and capitalize on short-term market fluctuations. While it can be exciting and potentially lucrative, it's also much riskier and requires a deep understanding of technical analysis and market timing. For most people, especially beginners, long-term investing is the way to go. It's a proven strategy for building wealth over time, riding out market volatility, and benefiting from the power of compound growth. Remember, in the stock market, time is your greatest ally. Let's dive into the world of mutual funds. Imagine a group of people pooling their money together to invest in a diversified portfolio of stocks, bonds, or other assets. That's the basic idea behind mutual funds. They allow investors to access a professionally managed portfolio without having to buy and manage individual securities themselves. When you invest in a mutual fund, you're buying shares of the fund, and the fund's manager uses the pooled money to buy a basket of assets based on the fund's investment objective. This diversification helps spread risk, as the performance of any single holding won't make or break the entire portfolio. Mutual funds come in all shapes and sizes, catering to different investment goals, risk tolerances, and time horizons. There are stock funds, bond funds, balanced funds, and even target date funds that automatically adjust their asset allocation as you get closer to retirement. Now, let's talk about a specific type of mutual fund called index funds. Remember how we talked about passive investing earlier? Well, index funds are the epitome of passive investing. Instead of trying to beat the market, index funds aim to match the performance of a specific market index, like the S&P 500 or the Dow Jones Industrial Average. Here's how it works. An index fund holds the same stocks in the same proportions as the underlying index it tracks. So, if the S&P 500 goes up by 10%, your S&P 500 index fund should go up by roughly 10% as well, minus any fees. Index funds are known for their low fees, simplicity, and tax efficiency. They're a great option for investors who want to keep it simple, minimize costs, and achieve long-term growth without the hassle of researching and selecting individual stocks. Let's explore another popular investment vehicle: exchange-traded funds, or ETFs for short. Think of ETFs as the cool, modern cousins of mutual funds. Like mutual funds, ETFs offer diversification by pooling money from multiple investors to invest in a basket of assets, such as stocks, bonds, or commodities. However, unlike mutual funds, which are priced only once a day at the end of the trading day, ETFs trade on stock exchanges just like individual stocks. This means you can buy and sell ETFs throughout the trading day at real-time prices. ETFs also tend to have lower expense ratios compared to traditional mutual funds, making them a cost-effective way to invest in a diversified portfolio. They offer flexibility, transparency, and a wide range of investment options, making them suitable for both novice and experienced investors alike. Let's talk about one of the most accessible and beneficial ways to start investing: your company's retirement plan, often referred to as a 401(k) or 403(b). If your employer offers one of these plans, it's like getting free money towards your retirement savings. Here's how it works. You contribute a portion of your pre-tax salary to the plan, and in many cases, your employer matches a percentage of your contributions. This employer match is essentially free money that can significantly boost your retirement nest egg. Plus, the money you contribute grows tax-deferred, meaning you don't pay taxes on it until you withdraw it in retirement. Investing in your company's retirement plan is a no-brainer. It's an easy way to automate your savings, take advantage of employer matching contributions, and benefit from tax advantages. Even if you're just starting out in your career, contributing even a small amount can make a big difference in the long run. Now let's talk about another powerful tool for retirement savings: the individual retirement account, or IRA. IRAs are like personal retirement savings accounts that offer tax advantages to help you grow your money faster. There are two main types of IRAs: traditional IRAs and Roth IRAs. With a traditional IRA, your contributions may be tax deductible, meaning you don't pay taxes on that money until you withdraw it in retirement. This can be a huge advantage, especially if you expect to be in a lower tax bracket during retirement. Roth IRAs, on the other hand, are funded with after-tax dollars, meaning you pay taxes on your contributions up front. However, the beauty of Roth IRAs is that your qualified withdrawals in retirement are completely tax-free. This can be a major benefit if you expect to be in a higher tax bracket during retirement. Both traditional and Roth IRAs offer unique tax advantages, and the best choice for you depends on your individual circumstances. It's always a good idea to consult with a qualified financial advisor to determine which type of IRA aligns best with your financial goals. Now that we've covered the basics of investing, let's talk about how you can actually start investing in the stock market. The first step is to open a brokerage account. Think of a brokerage account as your gateway to the stock market. It's an account that allows you to buy and sell stocks, bonds, ETFs, and other investments. Opening a brokerage account is easier than you might think. These days, you can open one online in minutes with just a few clicks. There are many reputable online brokerages to choose from, each offering different features, fees, and investment options. When choosing a brokerage account, it's important to consider factors like trading fees, account minimums, research and educational resources, and customer support. It's also a good idea to choose a brokerage that's regulated by the Securities and Exchange Commission, SEC, to ensure your investments are safe and secure. Now for the exciting part, investing your money. As a beginner, it's essential to start with investments that align with your risk tolerance and financial goals. Here are a few beginner-friendly investment options to consider. 1. Index funds. We've talked about index funds before, and for good reason. They're a great way to gain broad market exposure, diversify your portfolio, and achieve long-term growth without having to pick individual stocks. 2. Target date funds. These are a type of mutual fund that automatically adjusts its asset allocation as you get closer to retirement. They're a great set-it-and-forget-it option for hands-off investors. 3. Fractional shares. Don't let the price of a single share deter you from investing in companies you believe in. Many brokerages now offer fractional shares, allowing you to buy a portion of a share with a smaller amount of money. This is a great way to invest in companies with high share prices like Amazon or Google, even if you're on a budget. As you embark on your investment journey, it's crucial to remember that the stock market is a marathon, not a sprint. There will be ups and downs along the way, and it's important to stay focused on your long-term goals and not get sidetracked by short-term market fluctuations. One of the biggest mistakes investors make is trying to time the market, which is nearly impossible to do consistently. Instead of trying to predict when to buy low and sell high, focus on investing consistently over time, regardless of what the market is doing. This strategy, known as dollar-cost averaging, helps reduce the impact of market volatility and can lead to better returns over time. Remember, the stock market is a powerful tool for building wealth, but it's essential to approach it with patience, discipline, and a long-term perspective. By staying invested, riding out market volatility, and focusing on your financial goals, you'll be well on your way to achieving financial success. So there you have it. The stock market simplified. I hope this video gave you the knowledge and confidence to start investing and building a brighter financial future for yourself. Remember, the key is to start small, stay consistent, and invest for the long term. If you found this video helpful, please give it a big thumbs up and hit that subscribe button so you don't miss out on future videos about personal finance and investing. And hey, if you want to keep the learning going, check out these awesome videos on screen right now. They're packed with even more tips and strategies to help you master your money and achieve your financial goals. Click on one and let's keep learning together.